In this video, we're going to kind of conclude talking about leasing, right? Leasing assets for a corporation. Let's switch gears and talk a little bit about the lessor, right? So the lessor, the person that actually owns the asset, right? They have risks of their own. They have their own kind of analysis that they have to go through first just to figure out what lease price, right? What should the cost of the lease be to the lessee, right? How much should we charge them? One of the variables that's questionable is what is this asset going to be worth at the end of the lease, right? If there is a great deal of uncertainty, and I would think that there is a fair amount of uncertainty, the lessor absorbs that risk. So whatever that risk is, they're going to have to incorporate that somehow into the pricing mechanism, right? So increased residual value risk, that's what we're talking about. What is it worth at the end? Makes the lease more attractive to the lessee, but it's more risky to the lessor. So somehow that has to be incorporated into the process, right? So writing the lease for the lessor it's an investment, right? You're buying the asset for your business, and your business is leasing assets. So we need to compare, right, the returns on investments, right, with the other types of investments of similar risk. This is what we do for all kinds of capital budgeting projects, right? In this case, we're going to have to determine this for, each individual asset to determine, given the lessee and given the asset's life and its characteristics, we have to determine what is the actual value to the company of purchasing and then leasing out this asset. So in this case, where we were talking about the original project in another video, what if we charged $280,000 as the rental payment instead of $260,000, right? So again, what's going to happen? So everything else stays the same for the lessee, of course. But now for the lessor, how are we going to calculate this? So now we have we have to have the cost and depreciation of the asset. We're going to pay for the maintenance of that asset. Of course, there's tax savings because that's an expense. We're going to receive the lease payment. And of course, there's a tax on that receipt of revenue. There's the residual value at the end, and of course, the residual value tax we have to pay. So this, in the end, is going to provide us with just a very basic net cash flow from the lease itself. Now, if you use that 6% net cash, the 6% discount rate from before, we're talking about the net present value of about $25,000. The internal rate of return is 7.46. So the question here, should the lessor write the lease? Why should they? Well, if the discount rate 6% and this cash flow is going to give you 7.5%, that makes sense. And of course, the net present value is positive. So again, that makes sense. So this would be a good lease if we could lease it at $280,000. As a negotiation point, right? I think the way businesses like this work is they say, look, I'm going to buy this asset and I want a certain rate of return. Now, the discount rate here is 6%, but that's the cost of financing. What if we said, net, I need 10%, right? So The 6% is going to cover the cost, but the extra 4% is the additional profit that I need for this asset. You might want to discount at 10%, figure out what that is going to do to the cash flows, right? How is that going to affect them? And then adjust the payment so that you can get the rate of return that you actually want. As a matter of negotiation, right? I think we do this all the time, right? The lessee knows what they want to pay. The lessor knows what they need to charge in order to get the profits that they want. And then from there, we negotiate, right? And of course, the lessor is never going to offer the first time the lowest price to get them their profit. They're going to offer something else, right? So maybe this person says, look, 300,000 is what I want. The lessee says, no, I'll pay the 260, right? Say, no, I need a little bit more. So maybe negotiation gets the 280,000 that the lessor actually wants. So again, thinking back here, right? What was the lessor's net present value at 260? It's the negative, $18,000. If all the inputs are symmetrical, right? The leasing idea is a zero-sum game. That is the net outcome. Somebody's going to have, in this case, somebody's going to have a positive 18,000. The other person is going to have a negative 18,000, right? So what the lease cost essentially says is, in the world of building assets, right, the net increase to the economy is zero, right? Somebody wins something, somebody loses something. Now, of course, the lessor, since they're investing, the lessor never wants to have a negative net present value. So they would never, in this case, offer this lease at $260,000. They wouldn't make, or they wouldn't increase the value to the firm. Some of the characteristics could be also inside these leases are cancellation clauses, right? So again, what does the cancellation clause do to the lease? Well, to the lessee, it reduces the risk, right? If they can get out of the lease whenever they want, and they know what the rules are for getting out of that, there's a clause, then that reduces their risk, but it increases the risk to the lessor. Because if they do cancel, then they've lost the cash flow from the remaining part of the lease. And again, so if there is a cancellation clause, you can be fairly certain that the lessor is going to increase the payment or impose some kind of a penalty in that clause, right? Because again, they don't want to lose the cash flow that they're planning on, right? So finally, what else can we look at? What other kinds of characteristics are in these clauses that we might find important to understand? Again, what about the maintenance services, right? What maintenance services are actually covered, right? Which ones aren't covered? As far as reducing the risk for the lessee, right? What do we know about project life, residual value, operating risk? How can the lessee reduce those kinds of risk so that they can better ensure that they'll have the asset when they need the asset? And again, all of the interaction between the leases that you buy and the assets that you buy, that portfolio risk, right, that's going to be incorporated in the decision making. On the lessor side, this portfolio risk is an investment. So it's just like buying another stock. You're adding a stock to a portfolio. How does that affect the overall risk to the lessor? So again, that's the end of leasing. It's not a very complicated chapter. We just don't get to talk about it all that much. But leasing is, especially for some larger companies, leasing is a very important way of doing business. Um, Many companies now are leasing out entire departments, right? So there are universities, for instance, that their IT departments actually don't work for them. It is a leased service from another IT department. Sometimes the maintenance department is from somewhere else, right? So there's lots of ways we can incorporate and think of this leasing, right? And the outsourcing of many services is a type of leasing operation. I hope to see you soon. Take care.